Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, results rolling in from Bank of America, Citigroup, and Wells Fargo. They're all trading lower, and we'll tell you why and have the top takeaways from those earnings so far. Plus, tracking the AI data center build-out across the U.S., what it means for the price of power. And the growing popularity of ETFs, especially among younger investors, why some are even considering putting their entire portfolios into those ETFs. Let's take a look at the major averages right now. We are seeing them under some pressure here. The Dow right now is off by about 0.4%, or just over 200 points. The S&P off 0.8%. The NASDAQ down by 1.3%. Something standing out to me, though, because you see these three in the red, but look, the equal weight index is in the green, which is interesting here for the S&P 500. Let's take a look at the sectors within the S&P to get a little bit more insight into what is going on here. So as you might guess, typically when we see that kind of divergence, it has to do with tech. And indeed, we're seeing a sell-off continue in tech today. The XLK down 1.5%. Consumer discretionary also under some pressure, off by more than 1%. Now, counterbalancing that, we've got energy stocks continuing to rise along with oil prices, as we see some speculation for some kind of disruption to supplies from Iran, and then consumer staples are also holding up well. Looking at the NASDAQ 100 here, because we are seeing the NASDAQ under pressure in particular, we've got quite a sell-off going on in large cap tech right now. NVIDIA shares are down 2.5%. Broadcom is down by more than 4%. And then you see the rest of the Magnificent Seven and beyond, where we're seeing pretty significant sell-offs underway in today's session. And then take a look at the banks as well. Now, the banks have gotten some attention because guess what? They've performed at least on par with many of the large cap tech stocks over the past year. But since we've started to get these earnings reports, we have seen many of them come off of those highs. And the three big banks reporting earnings today are down in particular. Bank of America is down 4.4%. Wells Fargo is down more than 5%. And Citi is down more than 2.5%. If you switch on over and take a look at a one-year graphic, as we did earlier with our Jared Blickery, you see no red. All of these banks are up over the past 12 months. All of the largest banks, at least, are up over the past 12 months. So the sell-off that we're seeing today is coming after some very strong performance. Let's dig more into what we heard from the banks, because the earnings are underway amidst a backdrop of political noise and investor questions around credit, margins, and the Fed. For more, we're bringing Chris Whalen, chairman of Whalen Global Advisors. And Chris, it's an interesting earnings season thus far, I think safe to say. What are you seeing in these earnings reports that would explain the sell-off? Or do you think it is mainly because we've seen such a run-up in the stocks?
They performed very well, as you said. Once we got past the Trump announcement on tariffs, when they all sold off rather dramatically, and I told my flock, I said, get back in. This is a gift from the president. I think what happened was they weren't reporting tremendous earnings and growth, but the managers piled in. And so all of the stocks ran, although I would say the two best performers were small, SoFi and Lending Club. Lending Club's a tiny little bank, $10 billion, right? Very good performer, though. And JP, the rest of them had kind of started to fade. I think you're going to see more of that. The best performing non-bank was Citi, by far and away, even though they barely had gotten the book value. The improvements in the operating leverage and the other aspects of the the business that Jane Fraser's been able to deliver helped them to finally start to move. But I would tell you that the growth numbers are better. If you look at JP, for example, they put on 7-8% loan growth year over year. Deposits aren't growing that fast. That's a function of the Fed. So I think that you're going to start to see higher credit expenses this year, but it's still not going to be a crisis. The big ticking time bomb, I think, for the banks is private equity and credit, where we're playing games with disclosure, and that's going to come home to roost.
Okay, I want to talk about that, but first I want to linger on what we heard from Citigroup and from Bank of America today. Both of them relatively strong in terms of the core numbers, right? Even if we are seeing the sell-off. Wells Fargo is sort of its own.
But they're putting up more wood on the fire at Wells. They are growing.
Yes. Well, all of them are growing.
Right.
And
Finally.
If you look at the outlook for this year, and you look at the outlook for deal making, more IPOs coming to market, et cetera, that would seem to indicate that there is more growth to come, right?
Finally, we have not seen loan growth in these banks. They were underutilized all year, even as the stocks were going up. So now that we're finally starting to see balance sheet expansion, maybe investors are looking to take some money off the table.
Maybe it's priced in already? Is that the thing?
Well, sell on the news, right?
Yeah, well, but maybe then will people come back in after you get this little, is this
when you
this
start
a one
to
day
see bargains,
situation?
the only bank stock I own right now in my portfolio is Flagstar.
Flagstar, where's Flagstar based out of?
It's the old New York Community Bank.
Okay. Oh, of course.
And I know the team very well because they're all mortgage guys. They are slowly digging their way out of the hole. I bought it very cheap. But I haven't gone back into banks because I had some, American Express, Schwab, several others that I rode from April till kind of Labor Day. And then I bailed out because we were looking at double-digit gains. American Express is almost 8 times book. One of the best performing banks in the country.
Is this credit card thing going to happen?
No, definitely not.
Why not?
Because Congress would have to pass legislation and you would see a battle on Capitol Hill, the like of which we haven't seen in a generation from the banks. Jamie Dimon would lead the charge. So I think that, the president is speaking in an aspirational sense. But
when the banks come and say, well, this would be terrible for U.S. consumers because we just wouldn't issue them credit cards anymore. Is that, could the banks afford to still be relatively loose with credit? In other words, could they take off 5% of the people they lend to and still cap it at 10%?
No, the business doesn't work that way. You would have to have a portfolio that was so pedestrian and with such low loss rates that they wouldn't do it. Let me give you an example. Probably the riskiest credit card issuer in the country is Synchrony. Synchrony wrote off 5% of loans and total loans last quarter. That's normal for their business because they have a 20% average spread.
Right.
Their highest is probably close to 30. So all of these credit card businesses subsidize the bad loans with the good loans.
Right.
It's just the way it works.
Yeah.
We can just say, okay, nobody has credit anymore, or force people to come in and get unsecured credit lines individual by individual.
Right.
But even then, the banks, let's put it this way, the banks have been a little piggy when it comes to yields. They have been, because the rest of the book doesn't make a lot of money. This is why they don't own single-family mortgages. The returns on single-family mortgages are awful.
Yeah.
But on the other hand, credit cards and then loans to non-bank financial institutions, those are the two areas of growth for banks this year.
And the latter one is where you think there might be some trouble.
Oh God.
Okay, so talk to me. So talk to me about that. So you said earlier that you're watching private equity and the loans to these non-bank institutions like private equity and private credit firms.
Correct.
Very closely. Now, there's been a lot of words that were thrown around in 2025 about this stuff. Cockroaches was Jamie Dimon's word. Idiosyncratic was the word that everybody else seemed to be using.
Yeah, wharf rats.
That these aren't things that are very common.
Private equity is a world that is often misunderstood. It's mostly funded with debt rather than equity. And there are probably 15 to 20% of all private equity companies in the United States today that are essentially in default, but they're still paying by giving investors more equity. So this has the pernicious effect of causing the book value of these things to rise, even though the entity is essentially in default. The whole industry is whistling past the graveyard, and the banks have been lending to the private equity managers on a non-recourse basis. I think when some of these banks have to fess up and really talk about the actual credit quality of these portfolios, they're going to end up getting sued.
But as long as the economic cycle does not turn dramatically, can they keep going?
No, this is disconnected from the economy.
Okay.
This is a function of private equity firms that went out and bought everything and anything they could find because they earn fees. And then they can't turn around and sell the company. I'll give you a great example. J.D. Power and Associates was taken private by private. They can't sell it. It's unsaleable. And the canary in the coal mine here is the BDCs. If you look at business development companies that have to report under GAAP, what you see is that they are showing you a large number of their portfolio companies are doing what we call PIK, pay in kind instead of in cash.
So how is that going to play out this year, and will it happen this year?
It will play out in an idiosyncratic fashion. Every time one of these gets to the point where the sponsors can't wait anymore and the investors can't wait anymore, then they'll put it into bankruptcy and they'll realize the loss. The redemptions coming out of some of these private credit funds are astronomical. And yet, ironically, they're still raising new money.
I can't explain Wall Street sometimes.
No, the banks are always behind the curtain. You're never going to really understand what they're doing unless you dig into a lot of non-GAAP sources, talk to people in the industry, and that's where you start to understand what's going on.
And that's where you come in. So we're glad that you're here. Thanks,
My
Chris.
pleasure, Julie.
Appreciate it. Well, coming up, tracking the AI data center build out, what it means for consumers and the grid overall. Stay tuned. You're watching Market Catalyst. While companies put trillions of dollars to work on AI data centers, increasing concerns over energy capacity and resources hang overhead. Microsoft recently launched a community-first initiative to address some of these data center concerns after coming under fire from the president. But to better understand the bottlenecks and sentiment at play for the AI boom, William Blair is out with a new way to track it all. And Jed Dorsheimer, William Blair Group head of the energy and power technologies sector, is joining us now. Jed, this is a very hot topic, as you well know, in terms of what the build out looks like and what power is necessary to fuel it. So when you guys, as you try to figure out how to measure it all, how should people think about exactly what you're measuring and how to read it?
Yeah, so I'll explain the rubric behind our index. I think it's important. The reason why data centers are so important from our perspective, it's a great proxy because it's about 55% of load growth in the US. So if you want to kind of understand what does the grid demand look like, data centers are a great way to do that. So our index, which a neutral would be 50 and the best would be 100 and the worst would be 0. We take three different components. So first is data center demand. So we scrub 6,000 different projects that we get from Ontario that we subscribe to. So we're looking at satellite imagery, we're looking at water permitting, we're looking at power permitting, we're looking at funding. And those month over month, as those planned, we down select to about 1,963 that go into either active or in construction. And then that contributes about 35% of the score. So the month over month, how many basically of the funnel are going into either active or in construction, kind of checking those boxes. Then we have the supply side. So that becomes our demand side. Our supply side becomes the nat gas turbine. So most of this, all of this requires firm baseload. So you can kind of exclude wind and solar from this analysis. And so then we look at, have a proprietary power forecast that we use the McCoy data from is a kind of the basis. And we look at that on a quarterly basis. So what is that doing? That's another 35%. Then we actually have a proprietary survey that we have all of the hyperscalers are part of. So we have a blind survey that we go out and we get that back. And this has a series of different questions in terms of what's the likelihood of the project moving forward, funding, et cetera. And that's about 30%. And all of that rolls up into a simple, easy to understand and digest metric for investors that we hope will become the standard and help people understand what is this trend doing. And I'll pause there, but I think this is a really, really important development and study.
So what does 78 tell me right now?
It tells you that it's still really positive, but in the last couple months, you've come down, so it's not as positive as it was. And so that makes sense. Look at the credit default swaps for Oracle in terms of funding's become a bigger deal in terms of AI. And power remains the key issue. So, you're seeing President Trump tweet about these things or talk about it on Truth Social, I guess, in terms of, a BYOP, bring your own power. You're seeing Meta sign these types of deals with different nuclear suppliers. So you're seeing all of these different movements in here, and how do we get power? And why is that so important? Because you actually have some data centers that have already been built and they're dark. They've been filled out in Santa Clara and they can't get power. So if you underwrote that IRR basically goes to zero. And that's why power is becoming, electricity, when I say power, is becoming the most important factor in all of this.
And the data centers that aren't dark, as we know, have affected electricity prices, right, Jed? I mean, that's, so now you get this public backlash about power, about water as well, but your bailiwick is power. And so how does that play into the index or just the general, vibes, for lack of a better word, around the industry?
So yes and no. This becomes much more complicated. So in the late 90s, we went through a deregulation process for only the capacity market. So you have to understand how the grid is actually structured. And then when you kind of look at renewable portfolio standards and what's imposed on some of those utilities, there's different costs for transmission, distribution, and variability. So we published another report called The Power Behind AI about 2 years ago. So we were well in front of this curve. It was a statistically significant study looking at 538 different analyses. And so that data set, we saw that over 10% of your ISO, so the US is split up into 14 of these different ISOs across the country, or balancing authorities. With the PJM, you might hear about that. That's the largest and the most dysfunctional. As you get higher variable assets on that grid, the variability comes at a real cost. And that's actually what's pushing up prices. Certainly data centers are having an impact. I don't deny that. But what you're actually seeing is, if you look at, in our study, we have a heat map, you're actually seeing the data centers that are going in areas that have some of the lowest pricing. And so yes, that is having an effect on pricing, but you have an equal effect in terms of, where's pricing the highest? It's California, Hawaii, New York, Massachusetts. So you're kind of seeing these areas where you have high renewables, high prices.
So renewables are the reason that the prices have gone higher?
I think it's a mixed reason. I wouldn't say it's only one versus another, but
Gotcha.
When we say, hey, data centers are the problem here, that narrative is evolving, right? This is going to be a hot topic going into midterms. So the left wants to blame the right wants to blame the left. And so you really have to parse through the data. What's happening here is our economic system is shifting from a service-based economy, largely speaking, which was highly efficient, globalized, to bringing back resilience, which requires power, to onshore, and that requires firm baseload. And so that requires a different tool set, nat gas, coal, or nuclear for that base or hydroelectric versus variable solar or wind. That's actually what's having a great effect on the pricing mechanism.
One of the charts that stood out to me in your report looking at all of this was the power supply versus the data center demand. And you go out all the way to 2030, and we don't have the power that these data centers will need. And so that means we don't have the power that sort of the grid is going to be demanding here. So what then effect does that have on pricing and on the ability of these companies to build these data centers?
Yeah, it's a great point. And by the way, I'd point out that chart right there, the next chart that we have in our study, you would see that the deficit's even wider if you look. That's taking all of the new load and applying it only to data centers. Remember, I said data centers were 55%. So those, TSMC building that fab, or Intel building a new semiconductor fab, or a steel mill, or a chemical refining plant, all of that requires baseload. So the deficit's actually far greater. And just to put it in scale, you basically need to double the nuclear fleet to address the shortage that we have by 2030. And these are not like easy plug and play. We're going to bring this online in a relatively near term. So I think it's safe to say, we wrote another paper with a 5-point economic plan that we've shared with the White House for US, which we hope they follow, which basically says pricing is going to go higher. I think that is inevitable. How that's going to be, where the blame falls on that, I think is going to probably be political in terms of pointing fingers. However, you can't lose this race. And if you lose that race in terms of AI, it's the only disinflationary hedge that we have to a very inflationary system. So really, either you go back to a global diplomacy where everybody kind of gets along, or if you have to friendshore or reshore, you need both the power and you're going to need AI, and it becomes a chicken and egg type of phenomenon.
All right, Jed, I could talk to you for a very long time about all of this, but we got to leave it there. We'll have you back, I'm sure, to talk much more about this. Thank you.
Great, thank you.
Breaking news, the fate of President Trump's tariff still hanging in the balance. There's no decision from the Supreme Court coming today on the tariff case. Investors, consumers, and corporate America will remain in wait-and-see mode. The court has not yet said when the next round of rulings could come. The betting market still showing that it is unlikely the high court will side with the Trump administration. The latest numbers from Polymarket show a 29% chance the Supreme Court rules in favor of the White House. And this all coming as new data from the Treasury Department shows tariff revenue fell in December from November. And meanwhile, China recorded its largest trade deficit ever. In other words, it is exporting much, much more than it is importing, even with the tariffs. Coming up, we'll look at some of today's trending tickers and top analyst calls. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching L3 Harris, Rivian, and Tapestry. First up, L3 Harris, RBC Capital raised its price target in the stock to $360, up from $315. This comes after the defense contractor announced plans to spin out its missile business. The new entity will initially be funded by a $1 billion investment from the DOW, that's Department of War. RBC believes the DOW will invest through a convertible preferred security that will automatically convert to common stock in the new business following its IPO. The 12-month average price target on the street right now, $352. Next up, Rivian. UBS downgraded the stock to sell from neutral due to elevated expectations. The analyst there said that the market's appetite for Rivian's AI efforts may have reached a peak after the stock rallied 15% in mid-December following its autonomy and AI day. The street is pretty mixed on this stock. There are 10 buys, 10 holds, and 7 sell ratings. Last up, Tapestry, that's the company behind Coach and Kate Spade. Jefferies assumed coverage of the company with a hold rating after the firm previously rated Tapestry with a buy. The analyst said a strong December 2025 quarter and potential tariff repeal are both possible catalysts for the stock, but added that the upside is mostly reflected in the valuation. There are 15 buys, 5 holds, and 2 sells on the street right now. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout today's trading session.
Now time for some of today's trending tickers. We are watching home builders, silver miners, and crypto stocks. Markets and data editor Jared Blickreet here with me now. And Jared, let's start with what's going on with the home builders. D.R. Horton, Lennar, and Pulte Group. Those shares have been under pressure. The Trump administration's housing czar criticizing home builders for aggressive stock buybacks. Ironically, he is
Bill Pulte.
Home building family, Bill Pulte, that's right. So we've been watching those stocks. And by the way, we also just got some housing data out a little while ago in the form of existing home sales, which came in a little bit better than estimated, rose 5.1%, month over month. That doesn't have to do with the home builders directly because they build new homes, don't sell existing homes. But nonetheless, that's something else to just kind of put together with the overall housing picture.
Yes, and here's the backdrop. Fannie and Freddie, as we know, they guarantee loans to a lot of buyers of homes. And so this enables home builders to sell these homes to the public at costs that would otherwise be higher if they didn't have that liquidity support. So Pulte is saying that the stock buybacks and dividends that the companies have been making, which basically is returning capital to shareholders, that should not happen, or that it should be less. And he's saying that this demands a different business model. And I think that we should understand that indeed this is something it's just been the way it is for a long time. I'm not saying it's good or bad, but actions have consequences. And if you were to take away the buyback support and the dividend payments from these stocks, we would have a different business model, and these companies their stocks would probably reflect different prices, and they might be incentivized to do other things. So it's kind of like that credit card cap that's 10%. You can have a nice headline here, but when you dig into things, there are a lot of knock-on effects that you have to consider. I'll show you what the home builder stocks are doing today. Not surprisingly, on the Wi-Fi Interactive, they're all down. That's a lot of red there. DHI, that's DR Horton, that's down 1%. I'll show you what they've been doing year to date, and we're only halfway into January here, but a lot of nice green there. You can see DHI up 10%, Pulte Group up 12, Lennar up 19. Over the last year, if I change this to last 1 year, you're going to see not as bullish here, and that's because we're lapping that we're lapping that post-Liberation Day sell-off. But I'll put it back on year to date. Back to the main point, the buybacks that DR Horton did last year were $4.3 billion. Lennar did $1.7 billion. Pulte Group did $900 million. And so if they had shifted those funds into lowering their costs and really helping the home buyers out by lowering those costs, because we do have huge demand for houses in this country, and they're made affordable.
Let me stop you right there, Chair. Here's the thing. Many of these home builders have been doing that. They've been, with interest rates high, they have been offering incentives, a lot of these companies, to get people to buy homes, because otherwise they weren't moving the homes. And when he talks about profitability, if you look at gross profit or even net profit, and many of these companies, they're off their highs. So it has not been a great business over the past few years. So I find it a little ironic that right now he's sort of accusing them of
I'm not trying to,
it's just interesting. No.
And just to carry the thought experiment a little bit farther, so let's say that they did get rid of all these stock buybacks and their dividends, which is a fact that they have these. The prices of homes could be lowered by a bit, but it's just kind of going back to my original point, it changes the business model, and that's something to consider as well. Yeah,
and considers, it also throws into question whether investors would be as motivated to buy the stocks.
But they probably would be.
Right, yeah. So anyway, all right, let's talk about silver miners, because we're watching those stocks with the precious metals surging past another major milestone. Silver itself higher. We're seeing silver miners higher. They don't always go in lockstep here, especially in terms of magnitude. But we are seeing the silver miners go up today.
Yes, and they're kind of a levered play on what silver is actually doing. And silver is grabbing headlines because it has gone from $50 to now $90 per ounce in a shockingly short period of time. And we've seen some moves like this before, but I should point out that silver has essentially been in a multi-decade range for a long time. When it broke $50 per ounce, that was multi-decade highs that we're talking about. So this is a big thing. And the technical analysis slogan that I like to cite from time to time, the bigger the base, the higher in space. And so that's why we're seeing silver go into space right now. And then the silver miners, a levered play on that. Let's just go to the Wi-Fi Interactive and I'll show you what the silver miners have done this year. Now, two of the biggest ones here, WPM, FNV, they're more silver mining financiers, but nevertheless, we're seeing some decent numbers. But let me just show you the 1 year. All right, now we're seeing numbers in 3 digits here. Here is Hecla Mining Company. I'll show you let's get that back up there. I'm going to show you the 1 year chart, and you can see basically things really took off when silver was breaking out mid last year. And if I put a 5 year on that, well, you can see the breakout even higher. But I do want to show you this max chart, which goes back to the 1980s, because commodities tend to be mean reverting. They don't tend to trend up over time. They go up and then they go back down. They tend to be sideways. The miners tend to do the same thing. But we have seen a huge breakout here. We're just breaking through trading ranges. So this is an unusual situation. And then you throw in people who own coins. You throw in people who are buying ETFs. There is just a huge speculative fervor. And I can show you other charts here where this is still in a trading range. But I'm telling you, when these things break out and go this fast, the momentum that we've seen, we probably still have a lot more to be seen there.
Interesting. Well, speaking of speculative assets.
Well, I hope we're talking Bitcoin.
You know we are. We're talking about Bitcoin and crypto stocks too, because crypto stocks are rising, just like we were seeing silver rise and silver miners rise. We are seeing Bitcoin rising and then crypto stocks rising as well. So, and not just Bitcoin, we're seeing some of the other crypto assets rise as well. So a little bit of a comeback here to start off the year.
Yes, and Strategy is probably the most famous because they are that Bitcoin treasury company, highly levered to Bitcoin, which itself is highly volatile and speculative. But here's Strategy on the Wi-Fi Interactive. This is a 1 year chart, and you can see we had a big decline recently. This is from mid-2025, and we are just kind of coming up off of the lows. lows. Now, I'm going to compare this to a Bitcoin chart, and Bitcoin actually has risen to a 2-month high. And this is a nice technical breakout because with that little red line that I just drew in there, that was around 95,000. That was getting sold for the last, 6-8 weeks. And now, so that break above it just means that the short-term trend has now turned up. So long-term, we're still in this downtrend here. Super long-term, we're still in an uptrend. I'll show you the 10-year. All right, that's super long-term. That's an uptrend. But I'm going to go back down to the 1-year. And so this is a feather in the cap of the bulls here for Bitcoin. I'm going to show you one final chart. I'm going to compare strategy to Bitcoin over the last year. And this just shows you how the relationship between strategy, which is in this cyan line that I'm kind of drawing down here and highlighting, this decoupled from Bitcoin. And so my thesis is when strategy, I'm going to put this on a 1-month chart, strategy is now starting to overtake Bitcoin on some of the shorter time frames. When that happens, that tells me that we got a chance that Bitcoin re-enters that long-term bull trend, and then it has a shot at new highs.
Interesting. We'll see how that plays out.
Yes, we will.
Thanks, Jared.
Thank you.
And you can track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, the outlook for cannabis stocks in 2026, why the industry could have more room to run, according to our next guest. That's next on Market Catalysts. Cannabis stocks ended 2025 on a high note after President Trump signed an executive order urging the Department of Justice to speed up the process of rescheduling cannabis to Schedule 3. That's a category that includes substances eligible for FDA approvals as medications. Yahoo Finance's Josh Lipton spoke to Dan Aarons, Advisor Shares Pure U.S. Cannabis ETF Portfolio Manager, about what's next for the industry.
Dan, it is good to see you. So, big picture, you call this, Dan, here, you say the most consequential federal cannabis policy shift in more than 50 years. Maybe start there, Dan. Explain that for us. Why is this cannabis rescheduling, Dan, such a big deal for investors?
Well, we've been waiting on regulation for cannabis in the United States for some time now. And after it is a Schedule 1 drug on the DEA list, listed along with drugs that have no medical use whatsoever and very dangerous narcotics. Cannabis shouldn't be a Schedule 1 drug. It never should have been there. And we already have a multi-billion-dollar industry in the United States that's been allowed to grow on a state-by-state basis, with the feds basically having a look the other way approach. But these U.S. cannabis stocks can't list on the exchanges. They can't bank. They pay very punitive taxes. And we're badly in need of the regulation after it was promised back when Biden was first running for president. And we've been in this quagmire for 4 or 5 years now. And now it seems with the executive order that President Trump is definitely asking for the process to be complete, to make it Schedule 3, open up business, and open up a great deal of medical research as well.
Dan, you talk about how rescheduling cannabis here, you say enables 280E tax relief. Can you walk us through that in plain English? What is it? What does that mean? What would it potentially mean for a cannabis company's financials?
Yeah, many people don't understand this. And again, we have Canadian cannabis companies that don't face taxes like this and can actually list on the NASDAQ and the New York Stock Exchange. But here we're talking about U.S. cannabis companies, mostly traded OTC in the United States. They are saddled with this 280E tax, which taxes them as narcotics traffickers. They cannot deduct any business expenses, not a single business expense, not even payroll, certainly not rents and mortgages, anything like that. It's a huge, huge tax. So this rescheduling should pretty much automatically remove the 280E. If they're no longer a Schedule 1 narcotics trafficker, they're not going to face 280E taxes. We don't know yet what it's going to look and smell like, if it's going to automatically remove past years of taxes that many of these companies haven't actually paid. They've been letting some bills build up. There's a lot of things to unpack, and some people worry that, well, Trump asked for it, but it's not actually signed yet. Once it gets signed, which we think is definitely coming, we don't know yet what kind of safe harbors there might be, because removing the 280E tax is one thing, but people in our industry also want banking. We want listing on major exchanges. We want a lot of guidance from the DOJ for what adult use programs are going to look like around the country. So there's a lot to be learned still while we're waiting for this rescheduling to actually be enacted.
What would you say, Dan, that the big regulatory risks still are, though, that we should be aware of, that we should have on our radar as investors, that could derail all the potential upside we're talking about here?
Well, mostly we have a lot of fear right now because cannabis investors have been burned so many times over and over again over the last 4 or 5 years, when we almost got to the finish line with safe banking. We almost got to the finish line with the MORE Act, a number of different proposals that have been written in Congress and failed. And again, a lot of politicians, very empty promises. Again, starting back when Trump versus Biden was on the ballot 5 years ago. It's ridiculous. So what we have right now is a lot of investors on the sidelines waiting until it's real, waiting until it's signed. And the risks, as you ask for, are that we don't know if it's going to have safe harbor for banking. And I'm of the opinion that this rescheduling makes safe banking a much easier, much less controversial issue for Congress to pass. But hey, we're dealing with politicians here. How fast are they going to move on that? Are they going to negotiate it a lot? So the risks are, we don't know the timing. We don't know how quickly these U.S. operating companies can get the ability to list on NASDAQ or the New York Stock Exchange. We don't know if it's going to include banking. I'm viewing a multi-leg process, a big pop probably when we get the rescheduling, then maybe some volatility, maybe some pullback, and then multiple steps of figuring out banking, uplisting, medical programs versus adult use recreational programs. So a lot of volatility ahead, and investors shouldn't invest in something they don't understand, in something that they can't handle the risks and volatility of. And cannabis has been the most volatile place to invest in the past year. Even as you showed when you're introducing me that our fund outperformed the S&P 500 in the last calendar year, it did so with a great deal much more volatility.
And just in there on your ETF there, ticker MSOS, it is up about 40% here over the past year. I'm just curious, Dan, what makes your ETF sort of distinct and different than other vehicles tracking the space?
No, thanks for asking that. Our fund, MSOS, is by far the largest cannabis fund in existence. And investors like the liquidity that it offers, therefore, the options that are listed on it. It's an actively managed fund. And some people question, what does actively managed mean? We're not tactical. We're not trading it every day or every week. Actively managed simply means it's not an index. And when you have a unique industry, unique sector like cannabis, I will very readily say you don't want to be in a market cap weighted index. The largest isn't always the best. Our fund is very top heavy, very heavily weighted in the largest, most liquid, most successful cannabis companies in the United States. And then it has some much more immaterial exposure to some of the smaller companies that frankly might have more upside in this federal reform marketplace that we're looking at. So it's a spread out fund, and we're very low turnover, but actively managed in the fact that we're not following an index.
Dan, great to have you on the show as always. Thank you.
Thank you.
Coming up, a new survey finds millennials are leading the charge when it comes to the ETF market. We'll be right back. We saw record ETF inflows in 2025, and investors are still bullish for this year, with half of ETF investors saying they could see their entire portfolio in ETFs in the next 5 years. Some are even considering pulling money from individual stocks in favor of ETFs. This is all according to a new study from Charles Schwab. And let's bring in David Boxed, Schwab Asset Management Head of Innovation and Stewardship, for this week's ETF report brought to you by Invesco QQQ. Thanks so much for being here.
Thanks for having me, Julie. Great to be here.
So, David, I think we all sort of know on an anecdotal basis how popular ETFs have become. What I think is interesting about your study is just how popular and kind of what's driving it. So put some numbers around it and the enthusiasm that we are seeing around ETFs.
Yeah, I think first and foremost, you had the number on the screen. We saw in 2025 that strong investor appetite and affinity for ETFs come in the way of flows. $1.5 trillion in flows in a single year. I've been in the ETF industry for a long time. I remember when the ETF industry as a whole was only $1.5 trillion. Now we're seeing that level of flows come in a single year. We're also seeing asset managers like Schwab Asset Management meet that investor demand by bringing new and innovative products to market to really help investors meet their long-term investment objectives.
David, as somebody who's been in this industry for a while, as you just mentioned, what has been sort of the tipping point, or what has been, or maybe there have been multiple, what do you think has been the thing that has driven that popularity?
I think there are probably two or three things that really drive that popularity. One is accessibility. Investors have indicated in this study we've been doing over a decade that ETFs provide them accessibility to asset classes and easy entry points. That intraday tradability and the ability to access is really a strong point. Number two is the cost. ETF investors also indicate that ETFs allow them to help reduce the cost of their overall portfolios, and we know that reducing costs lead to better long-term outcomes. And number three is just the increase in market education and acceptance of ETFs. ETFs have been around for over 25 years. Increasingly new entrants into this market, like the millennial generation, have always had ETFs around. They've known about ETFs since they were young and have that willingness and ability to go into ETFs and a great knowledge about ETFs.
Yeah, and indeed, as you found in your survey, that millennials are the ones who are really driving this by the largest percentage here. What do you think about the role of ETFs in 401ks? We have seen some adoption in those plans, but they're still very reliant on mutual funds. When does that start to change in a more decided fashion?
It has been a barrier to ETF growth and getting into retirement plans, primarily 401ks. Now, we have to think about what the benefits of ETFs are. I just talked earlier about accessibility. Most individuals in their 401ks aren't actively trading every day. Instead, those investments come in regular distributions and income from their paychecks, which comes every week, every 2 weeks, once a month. So that tradability that ETFs provide don't necessarily mean as much in a 401k plan. What we have seen in 401k plans increasingly that's similar to the ETF market is a greater use of index products and a greater use of low-cost products in 401k plans. So that is ringing true in the way that investors allocate their 401ks in much the same way they're allocating their taxable accounts outside their 401ks using ETFs.
And then speaking of allocation, about 25% of the investors you surveyed in ETFs are going to use them for alternatives. And we've seen a real increase in products that are available to access those types of alternatives. And we're putting them up on the screen here, the types of alternatives that people are looking at here. How many more products are we going to see? How much of a growth area is this? And are there any sort of pitfalls with offering ETFs that offer people access to alts?
I think we hear about alts, and especially all the conversation in 2025 really stemmed around more traditional alternatives, lower liquidity alternatives, private credit, private equity come to mind. But when you look at the chart you have on the screen, what you see at the top of that list are more traditional alternatives of how do you think about reallocating a traditional 60-40 equity fixed income portfolio, bringing alternatives like commodities, like real estate that can provide some diversification benefit over time and in markets like we've seen most recently with things like gold and silver, perhaps outsized returns. We're also seeing from that younger generation, going back to that millennial investor, other types of alternatives, newer asset classes like cryptocurrencies, the increasing affinity that brings in an account to provide diversification benefits, we are also seeing ring true. Perhaps when you think about the pitfalls, when you think about things like private equity, private credit, we've got to make sure that the underlying securities have sufficient liquidity so that tradability of the ETF doesn't get diminished in what we're providing investors access to.
Yeah, that is really the question for those products. It's going to be an interesting couple of years on that front. David, thank you so much. Appreciate it.
Thanks so much for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. More Yahoo Finance coming up.